Hey there, money mavens! Let's demystify the world of finance, one step at a time. Today, we're diving into two key players, money markets and capital markets. Think of them as the twin engines powering the global economy. They might sound intimidating, but trust me, they're simpler than you think. In the simplest terms, the money market is your go-to for short-term borrowing and lending. Picture it as the express lane of finance, where transactions happen quickly. On the other hand, the capital market is all about long-term investments. It's where companies raise funds for growth and expansion, and investors seek to grow their wealth over time. One of the biggest differences between these two markets is the investment duration. Money market instruments typically mature within a year. Think of them as your short-term financial solutions. Need to park your extra cash for a few months? The money market is your friend. Capital markets, on the other hand, deal with securities that mature over a longer period, often several years. These are your long-term investment vehicles, where you aim to grow your wealth over time. Buying a house, funding your retirement, or simply watching your investments compound, that's the realm of capital markets. Now, let's talk risk. Money market instruments are considered relatively safe. They offer modest returns, but your principal is generally well protected. It's like keeping your money in a high-yield savings account. You know it's there when you need it. Capital markets, while offering the potential for high returns, come with higher risk. The value of your investments can fluctuate, and you could potentially lose money. It's a high-stakes game, but with calculated risks, the rewards can be substantial. Section 4. Instruments. A glimpse into the financial toolkit. Each market has its own set of tools, or financial instruments. In the money market, you'll find instruments like treasury bills, commercial paper, and certificates of deposit, or CDs. These are your short-term debt instruments, favored by institutions and individuals alike. The capital market boasts a more diverse range of instruments, including stocks, bonds, and derivatives. Stocks represent ownership in a company, bonds are debt securities, and derivatives are financial contracts that derive their value from an underlying asset. Section 5. Participants. Who's who in the financial markets? The players in each market also differ. Money markets are primarily dominated by institutional investors like banks, governments, and corporations. These big players use the money market to manage their short-term cash flow and liquidity needs. Capital markets, on the other hand, witness participation from a wider spectrum of investors, including individuals like you and me. Retail investors, mutual funds, hedge funds, and insurance companies all flock to the capital market seeking long-term growth. Section 6. Purpose. Fueling immediate needs and long-term growth. Ultimately, both markets serve distinct purposes. Money markets provide businesses with short-term liquidity to meet their operational expenses. They're the oil that keeps the engine of commerce running smoothly. Capital markets, on the other hand, fuel long-term economic growth. They allow companies to raise capital for expansion, creating jobs and boosting the economy. They're the driving force behind innovation and progress. Section 7. Conclusion. Navigating the waters of finance. So, there you have it, a crash course in money markets and capital markets. Understanding the differences between these two is crucial for making informed financial decisions. Remember, both markets play vital roles in the global economy, catering to different needs and offering unique opportunities for investors. Whether you're looking for a safe haven for your short-term savings or seeking to grow your wealth over the long haul, understanding these markets is your first step towards financial empowerment. So go ahead, dive in, and explore the exciting world of finance.